Hey everyone, Douglas here, Kind of Market Analysis, and welcome back for another update. So, as of October 1st, 2019, so 2 weeks ago, the U.S. is officially in a new fiscal year, meaning federal spending for fiscal year 2019 has come to a completion. We're now in fiscal year 2020, and because of that, the Congressional Budget Office has tallied up the budget, all the spending for fiscal year 2019, and come to the conclusion that the federal deficit for fiscal year 2019 came in at just shy of $1 trillion. Now, this news, unsurprisingly, has brought the deficit hawks out of the woodwork, and even many market commentators, market pundits have expressed kind of the dangers, the risks of a massive U.S. deficit. But here's the thing, and this is kind of the main point I want to make in this update, is that the deficit, at least for how I kind of model, how I analyze, how I look at the markets, is really kind of a key component. Maybe you call it really the absolute kind of foundation or the most important building block to how I analyze the markets, but more specifically to higher equity prices and a stable economy that's going to kind of undergird the financial markets. Now, in the past, I've kind of addressed this topic from a more economic policy standpoint, and I've shown how the deficit hawk doomsday scenario is really predicated on a very faulty view of how the economy works. So tonight what I want to do is kind of show more specifically how this all works out as it relates directly to equity prices. And I'm going to show that from a flow of funds perspective, because I think this is going to illustrate quite well why a rising deficit, or again, more specifically, large amounts of fiscal spending are really key to the direction of equity prices. Now, if you're a member over at my Patreon page, make sure you check out this week's macro update, the most recent one I just posted Sunday evening, because I went over, not only we're going to cover tonight, but I went over kind of the main factors that I consider. So not only the fiscal spending, but also how that fiscal spending relates to the financial system, how it relates to the different risks within the financial system, such as the rising private debt to GDP ratio, the rate of change of that ratio, and how all these different elements play out throughout the business cycle, and how we can assess and model each factor and weigh it, and weigh that risk of each of these to kind of better understand what sort of outcome we can expect, say, in equity markets. So check that video out if you're a member, and if you're not, patreon.com/CannonMA is where you can find that. Anyway, what I want to do for tonight's video is I want to bring up an empty I guess you call it workflow model here, and we will go from here. We'll build upon this, and what we're going to do is we're going to go kind of step by step. I'm going to build a very basic kind of flow of funds model, and to again show what's happening with fiscal spending as it enters the economy. So again, I kind of hope this is going to be a good tool to illustrate why this should really be a core feature to your analysis. So quick caveat before we get going here. I realize what I'm about to show is a very simplified model. I've left a lot out. You're not going to see central banks in here. It's just going to be kind of the core component. So I've left a lot out, and there's a lot that could be added to this model. But again, I need to just show the core components, get that across, so you can get the concept, and kind of show why, why fiscal spending is very important to equity markets. So here's what we're going to do. We're going to build this up one component at a time, and I'll kind of go over these as we go along. So all right, so let's go ahead and get this model started, and we'll go through this relatively quickly. So let's start again where this whole story starts, and that's going to be with the federal government. Treasury. And again, all money is going to originate from there. And the federal government its spending is essentially received by two recipients. And those two recipients are going to be households. So we can add that. And the other one is going to be companies, businesses, corporations, so whatever you want to call that. So we'll go households. And we'll go ahead and add the second one, which is going to be, again, companies. So we will add that. And again, these are, if you look at the daily treasury statement, you're going to see that the two main withdrawals, so the two main funding directions are going to be households or companies. And for households, your main kind of spending items are going to be Social Security, Medicaid, Medicare, SNAP, food stamps, that sort of thing. So those are going to be your main, your main flows to households. Again, if you look those up on a line item, go ahead and actually we're going to do this as blue. And then for companies, your main, federal fiscal spending is going to be defense spending. That's going to be the biggest line item there. So the money flows out. So the government buys the goods and services of the people, and the money flows out to them, or they just do straight up transfers to in the sense of like Social Security or something like that. So not necessarily buying goods or services. So that money goes out to households and companies. And the decisions that households or companies have to make are pretty easy here, right? If you have a Social Security check that you get, you can either spend that, so you're going to spend that on rent, or you're going to spend that on some sort of consumption, in which case that flow is going to go from households to companies, right? So you're going to spend it you're going to spend it, and that's going to enter the private sector and do what it does. Or you have the option, if you're not going to spend it, to save it. And if you save it, that is going to go into the kind of final sector that we want to add to our model, and that's going to be the financial sector. Okay, so government money, Treasury, they buy goods and services, or they do kind of just transfers, payments of, say, Social Security or defense spending or paychecks for federal employees. And that money either gets spent, and that spending either ends up with companies, or that money can be saved. So again, we will show the flow going into the financial sector as one other option. And the same thing with companies. Some of that money that companies get is going to end up in households, okay? Or it can end up back in the financial sector as well, in terms of savings. So the financial sector just essentially being the banking system, okay? Now, even this simplistic model, let's think of some outcomes to what's happening. Let's say, $1 trillion over a year is flowing out, day in and day out, is flowing out from the government to households and to corporations, and the savings of that ending up in the financial sector. What's happening here? Well, let's just go from the company standpoint. If government spending is going to companies, that's going to be an increase in profits, right? Which is what companies want. So if you get more government spending than anticipated, you can probably guess that profits are going to be higher. And of course, part of profits get shared to shareholders. And so we could add another node here just to kind of represent, ourselves, the investor, right? So part of profits are going to go out as either buybacks or dividends to shareholders. So we can kind of show this in terms of profits going here. And of course, that is that's a net benefit. That's a net benefit for equities, right? If profits are higher and those profits are going to shareholders or going to corporations, that's going to boost equity prices, and all in all, that's a good thing. Again, if our core mission here is to know to be long or short the equity markets. Same thing with households, right? So if the flow goes through the government to the households, and the households spend that on companies, again, the companies, part of that is going to be more profit, and that is going to, again, increase equity prices. Now, the second option is that they're just going to go ahead and save that. Well, a lot of that savings goes into things like pensions, 401ks, right? It's entering the financial market. This too is going to be a benefit to equities as well, because again, you're going to get more money, you're going to get more buying pressure for new stocks. There's going to be there's going to be buying pressure, and then on top of that, you're going to get a more robust financial sector that's going to have more risk assets on the books, and that increases the valuation of the financial sector as well. So we can go ahead and say that that is a net positive as well, and just generally, again, supportive of if I can move this of equity prices as well. So there's a very basic model that can be played out. Now, sometimes the households or companies don't have enough money. There's not enough coming in and in fact, most times from the government or the Treasury sector to fully meet the both savings and spending needs of households and companies. So this is where the financial sector, the banks, play a dual role. Not only can they invest the savings that's going to come into them to enhance their their balance sheets, but the other thing they can do, that banks are kind of, the purpose of a bank is to extend loans to households and companies, so households and companies can do whatever they want or whatever they feel like they need with that money. So that is another avenue that we need to follow from a flow of funds model. So let's do this. So households can obviously get loans for things like houses, for example, right? That'd be an obvious one. Other purchases such as cars and that sort of thing. So, they're going to do this by going into debt. Maybe not the best idea, but it still happens. And so we're going to go ahead and show that flow as kind of an orange line here. And of course, households are buying from companies, right? So, we'll do this. They're going to buy from companies. So you can now see how the flow is coming from the borrowed money to the company. And of course, companies are going to then, part of that is going to go to profits. We already discussed that, and that's going to benefit shareholders. And the other part of that will go back to the financial sector as savings and kind of complete the flow. The other thing too is companies themselves can go into debt, obviously, and probably more productive than households going into debt. But the same thing can happen where companies can go into debt, and that again increases the flow of money. We've seen this with debt expansion, essentially paying for share buybacks and that sort of thing. Again, it continues the cycle. And this whole cycle so far has been predicated on a kind of necessary flow of government spending. So the question is, what if government spending slows down, right? Like what happened before 2000 and what happened before 2008? Or what if it completely disappears like it did before 2000 and we get rid of this entire flow right here, and in fact we reverse the flow? We'll show that in just a second, but we'll reverse the flow where there's money coming out of corporations and households back into the government. Well, what's left? All that's left is this right here, right? All that's left is a borrowing kind of economy, right? Where it's the financial sector that is doing all the lifting for any sort of growth that can come out of this. Now, what we saw happen in the lead up of 2000 and in the lead up of 2008 is we saw a massive bubble occur, right? And we've learned from the works of Steve Keen, Hyman Minsky, and whatnot that this bubble becomes unsustainable, right? There's a critical mass where the financial system can no longer handle the growth. In Minsky terms, this is when the Ponzi schemes start to come in, where this can't function anymore, right? And deleveraging starts to occur. So in the meantime, it can, right? I mean, there's a buildup where this can happen, and we're still, even without the federal government, we're still getting the growth. But eventually, the debt dynamic happens, and you get an implosion. And what happens in the implosion is a complete reversal of the flows that we've seen so far. Instead of financial sector extending loans to households, the households now go ahead and deleverage back into the financial sector. So they're actually removing money not as savings anymore, but as paying back the loans. And the exact same thing with corporations or companies. They're no longer going to be putting their savings in because they're not getting any more from the federal government, and they too have reached their kind of max threshold. And they too will deleverage as well. And so you've got, again, red line to express deleveraging. Households then no longer have money to buy goods and services. They're obviously not going into debt anymore. They have no more savings because one avenue for savings has gone out, and on top of that, they are in too much debt, so they're deleveraging. So they have no more payments to go, and then that leads to things like layoffs. So companies no longer can pay households, and obviously the financial sector no longer wants to lend to corporations, so you just see a massive deleveraging. And then on top of that, in a worst case scenario like we saw heading into 2000 and 2008, you actually see deleveraging occurring in this direction too, through higher taxation, right? Especially in 2000 when we saw a surplus, a fiscal surplus. So you have money being literally siphoned out to the financial sector and the government sector when the roles reverse. This is obviously not conducive to higher equity prices, right? From a shareholder perspective, what used to be dividends and buybacks are now going to reverse, and the risk from the financial sector is that they might become insolvent and might have to fire sell their assets, which is what we did see in the latter halves of the great financial crisis. So what ends up happening, and what we did see in reality play out, is the government stepped back in and became a net in a deficit, a net essentially issuer of new currency, and reignited the process. I keep doing that, I apologize. Reigniting the process of allowing new money to once again enter the economy and stop the death spiral. And those are oftentimes called like automatic stabilizers kick in. So that's the life cycle of how the kind of economy functions, or how the business cycle functions, from a perspective of looking at the fiscal flows as kind of that most important core piece, or the beginning piece in that cycle. So here's kind of the core takeaway from all of this, or at least I hope that I was able to express, is that money in its truest sense can really only come from the government, from the Treasury. Now, this can change theoretically, but in our economy, the most basic form of money is that sets on the liability side of the Treasury balance sheet. And any other kind of money, whether that's kind of endogenous bank loans or anything like that, or whatever else other form of derivative dollar, has to come and has to derive itself from the dollars that are coming from the government or the Treasury. And this is why I'm so keen on watching the fiscal flows, because if they start to wane, or we start to see any issues with that in credit money or bank endogenous money, or whatever you want to call it, bank loans begin to increase and sustain the growth of the economy, then the dynamic is the kind of debt dynamic is bound to take over the dynamic that we saw take over in 2000 and in 2008, and I think that's when we see the recession. And more importantly, that's when we could see some damage to equities. Now, I know there will be some of you out there that are still going to be adamant that a large deficit is a real problem to the real economy. And you can maybe argue that this is going to be a misallocation of resources, or whatever risk you might see, and you might be right. But what I really kind of want to try and get across is that as a trader, it is what we're looking for really is the causal factors for rising equity prices, and it's really the fiscal spending, which is key, or a key, if not the key, component to understanding what's causing higher equity prices. And at the end of the day, it's kind of my job, right? It's our job as traders, investors, to be long stocks when the market is an environment that is bullish, and to be in cash or even short stocks when the market environment is bearish. And my point is this, right? We can discuss kind of more abstract consequences to large government spending, but if you're going to be successful in trading, investing, and the key is going to be keeping kind of that ideology, whether it's left, right, or center, out of your research and analysis. And I'm not saying there isn't a place for that, but it's certainly not in the decision tree for when you're trying to make some sort of investment decision. So anyway, I'm going to digress with that point and just say that I hope you can understand why large deficits really do promote higher equity prices, and the risk that gets introduced to equity markets when we don't see large deficit. So here's the thing. This is why I like to follow the fiscal flows, and I do this on a week by week, kind of actually day by day basis, where I calculate the actual flow using a different methodology, because I'm trying to narrow in on the flow itself, not the actual deficit, which is why I like to call it fiscal flow as opposed to fiscal deficit. So I'm using a slightly different methodology than the CBO. and that I look at, and I'll follow that flow. In fact, I get it from the daily Treasury statement. It comes out daily. You can look that up on the Treasury website. Just Google it, and these flows have very far-reaching implication on what's going on in all the markets. So, look, if you're intrigued by this kind of analysis, make sure you check me out over on my Patreon page. Again, I break this down in a lot more detail over there in my weekly updates, my weekly reports. So yeah, check me out over there. And if you're new here as well, just make sure you click that subscribe button on the YouTube channel and turn on that notification bell. You won't miss an update going forward. So anyway, I hope this was a helpful update this evening. And yeah, as always, good trading, everyone. We'll see you next time. Bye-bye.